Most traders come into the market with only one goal in mind: to make as much money as possible. They picture fast gains, quick wins, and instant success. But very few ever stop to think about what can go wrong. Richard Wyckoff, one of the great minds in trading, used to say that before you think of profit, you must first think of protection. He believed the first question a trader should ask before taking any position isn't "how much can I make?" but "how much can I afford to lose?" This mindset is what separates professionals from the crowd. The public always wants to imagine rewards, but professionals think in terms of risk first. That is why Wyckoff insisted that loss management is not just a part of trading, it is the heart of it. Trading is not gambling, it is a business. And like any other business, it demands structure, discipline, and preparation. Before placing a single trade, you must know exactly why you are doing it, what could go wrong, and how you will handle it if it does. Too many traders approach the market without a plan, guided only by excitement or fear. But the market doesn't reward emotions, it rewards discipline. Wyckoff taught that a trader must record every action, the reason for entering, the result, the size, and the conditions. Over time, these records become your greatest teacher. You begin to see patterns in your mistakes and learn where your weaknesses lie. The difference between a losing trader and a winning one is not luck, it's preparation, awareness, and control of risk. The first major error most traders make is overtrading. Overtrading happens in two ways. The first is trading positions that are too large for your account. The second is trading too frequently without clear reasons. Both come from the same root: greed and impatience. You see a few wins and suddenly believe you can do no wrong. You double your size, add more trades, and soon the market humbles you. Professionals never overtrade. They start small, scale up gradually, and only add to positions that are working. They understand that survival comes before success. It's not about how many trades you take, it's about how well you manage each one. Wyckoff used to say, "Your capital is your ammunition. Never waste it. Once it's gone, the battle is over." To protect that capital, the most powerful tool you have is the stop loss. A stop loss is not a sign of weakness or fear. It is your insurance policy against disaster. The purpose of a stop loss is not to eliminate all losses. That's impossible. Its purpose is to make sure that no single loss destroys your ability to trade again. Many traders fall into the trap of moving their stop once the price moves against them. They convince themselves that if they just wait, it might turn back. But the market doesn't care about hope. Moving your stop is like cutting the wire on your parachute because you think you might not fall. Once you set a stop, it must stay there. If the market proves your trade wrong, take the loss, learn from it, and move on. Professionals don't measure success by how often they win, but by how well they control damage when they lose. Another key idea in Wyckoff's teachings is the reward-to-risk ratio. Every trade you take must offer at least 3 times the potential reward compared to the amount you're risking. Before you enter a trade, you should be able to clearly define 2 levels: your stop loss and your target. The distance to your stop is your risk. The distance to your target is your reward. If the reward is not at least 3 times greater, skip the trade. This rule alone can turn an average trader into a profitable one over time. You could be wrong half the time and still make money if your winners are bigger than your losers. The mathematics of trading are simple, but the discipline to follow them is not. Placing your stop loss correctly is both an art and a science. The stop must make sense based on market structure, not on how much money you feel comfortable losing. A good stop is placed at the point where your trade idea becomes invalid. If you are buying, your stop should go below the level that, if broken, proves the market is weak. If you are selling, your stop should go above the level that, if broken, shows strength. Wyckoff explained that stops should be positioned based on logical price action levels, not random round numbers. If you are going long, your stop might sit below the low of a spring, a secondary test, a pullback, or the last significant reaction low. If you are shorting, your stop might go above the high of an upthrust, a rally, or a last reaction high. These are technical levels where a break has meaning. It tells you the market's intention has changed. The mistake amateurs make is putting stops too close. They fear losing money, so they place stops within normal price noise. The market takes them out again and again, not because their idea was wrong, but because their stop was in the wrong place. On the other hand, professionals place stops where the market must prove them wrong. They accept that price will fluctuate, and that noise is not the same as reversal. Your stop should always have logic behind it, a story that makes sense. If price breaks this point, the reason I entered the trade no longer exists. That's the mindset of a professional trader. Once your trade moves in your favor, the job isn't done. Now you must manage the profit. Wyckoff taught that profits should be protected but not smothered. One effective method is to trail your stop, that is, to move it gradually as the trade progresses. For a long position, you might raise your stop to just below each new reaction low. That way, if the trend continues, you stay in. But if the market turns sharply, your profit is safe. As the trade develops, your stop eventually reaches your entry price, a point known as break-even. At that stage, the trade is risk-free. No matter what happens, you cannot lose. This is the ideal psychological position, calm, clear, and confident. But there's a trap here too. Some traders move their stop too soon. They fear giving back profits, so they tighten the stop aggressively. Then a small normal pullback hits their stop and kicks them out, only for the market to run again in their original direction. The balance lies in patience. You must give the market room to breathe, yet never allow a winning trade to turn into a big loss. Trading is constant decision-making under uncertainty, and stop management is the bridge between protecting profits and letting them grow. Wyckoff also discussed advanced stop strategies. One is placing stops at odd fractions, like 62 and 7/8 instead of 63. This avoids being stopped out by the crowd, as most traders use even numbers. Another is avoiding illiquid markets, where stops can be skipped or slipped because there's not enough volume at your price. And for very skilled traders, there's the concept of a double stop reversal. This means that when your stop is hit, it automatically triggers an opposite trade. For example, if you're long and the market breaks support, that stop out could become your entry for a short. This approach is for professionals who understand both trend and structure deeply, but it illustrates the level of precision that stop-loss thinking can bring. It's important to understand that a stop-loss is not only a tool for individual trades, it's the foundation of your entire risk management system. Think of it as a compass. It keeps you oriented no matter what the market does. Without it, you drift in uncertainty, reacting emotionally instead of acting rationally. Every professional trader has taken losses. In fact, most pros lose more often than they win, but they lose small. The secret is that they never allow a single trade to damage their capital or their confidence. Each stop hit is just a small cost of doing business. The amateur feels pain and fear when stopped out. The professional feels clarity. A stopped-out trade means new information. The market is saying, you were wrong this time. And that's fine because you live to trade again. Over time, this mindset builds strength. You begin to see that trading is not about perfection. It's about probabilities and control. You stop judging yourself by your win rate and start measuring your consistency. You start valuing patience more than excitement. You start trading fewer setups, but each one with greater conviction. You become selective, waiting for clear structure, strong confirmation, and a good reward-to-risk ratio. When those elements align, you strike, not with fear, but with confidence backed by discipline. That's what Wyckoff meant when he said trading is both an art and a science. There's a rhythm to professional trading. You study, you prepare, you plan, you execute, and you review. Every trade, win or lose, teaches something. Over time, you refine your system, your psychology, and your execution. The market becomes less of a mystery and more of a mirror, reflecting your habits, strengths, and weaknesses. Stop-loss discipline becomes second nature, not an afterthought. You start every day knowing exactly how much you can lose if wrong and what you stand to gain if right. That's the mindset that creates long-term success. Many beginners look at stop-losses as limits. They think it's a rule that keeps them from making big profits. But in truth, the stop-loss is freedom. It gives you permission to act boldly because you know your risk is contained. It removes fear because your worst-case scenario is defined. When you trade without fear, you make better decisions. You stop hesitating, stop second-guessing, and start thinking clearly. That's why Wyckoff called the stop loss a complete system of capital management. It's not just about protection, it's about empowerment. The stop gives you structure, and structure gives you confidence. At the end of the day, trading success doesn't come from prediction, it comes from preparation. No one can predict every move. The market is too complex, too dynamic, but anyone can control their behavior. You can decide how much to risk, where to place your stop, when to exit, and how to learn from each outcome. You can't control the market, but you can control yourself. And that's what makes you a professional. When you master stop-loss discipline, you stop fighting the market and start flowing with it. You begin to think like an investor in probabilities rather than a gambler in hopes. You start accepting losses as natural, expected parts of the process, small, controlled, unemotional. And that's the point when everything changes. Because then, for the first time, you're not just trading, you're running a professional business. A business with risk plans, systems, and standards. That's what Wyckoff meant when he said the trader's first job is not to make money. It's to stay in the game. And the stop loss is what keeps you there, trade after trade, year after year.